A risk model can be sound and still mislead because it describes the wrong world. An insurer may have millions of comparable lives. A first-of-its-kind product may have no defensible reference class. Before trusting a probability, ask one question. Does the process behind the data still match the process that will generate this outcome? Check the cases, the conditions, and any behavior the model itself may trigger. If the match breaks, use scenarios, limit the cost of error, keep the next step reversible, and set an update trigger. This is not an argument against models, it is a test for knowing where their authority ends. Peter Bernstein's history of risk against the gods describes the long shift from treating uncertainty as fate to measuring it with probability. That achievement changed insurance, science, engineering, and finance. It also created a temptation to give every uncertain future a precise number. The useful boundary is not between numbers and intuition, it is between a reference process and a target process. The reference process produced the data. The target process will produce the outcome you care about. A probability loses calibration when those two processes differ materially. Calibration has a practical meaning. If a model repeatedly assigns a 20% probability to comparable events, roughly 1 in 5 should occur over enough trials. The estimate earns trust by surviving contact with the outcomes it was designed to describe. Process mismatch can happen in 3 ways. It can exist from the start because there is no defensible reference class. It can emerge over time because the old reference process was useful, but the target process changed. Or it can emerge through feedback because using the estimate changes the target process in a way the model omitted. These are not 3 unrelated objections. They are 3 routes to the same failure. The model describes one process while the decision faces another. Start with a case where the match was strong. In 1693, Edmund Halley published an analysis based on records of births and funerals from Breslau. Halley is remembered for the comet, but these records let him examine mortality across age groups and connect population patterns to payments tied to human lives. The table could not tell one 40-year-old when he would die. That was not the target. The target was the number of deaths across a sufficiently large population over a defined period. Here, the reference process was observed mortality among many people. The target process was mortality in a comparable population. Individual outcomes remained uncertain, but the group produced a pattern useful enough for population-level decisions. The reliability consequence was narrow but powerful. The table could support estimates across a pool. It did not convert a population frequency into certainty about one person. That boundary is easy to miss. A population-level estimate can be useful without identifying which individual outcome will occur. When the reference match is strong, use the estimate at the level where it earned its record. Keep the population, time horizon, outcome definition, and relevant conditions visible. Do not quietly move from a group frequency to an individual promise. Now consider the opposite case, a new product with a claimed 63% chance of success. The reference process might be 10 earlier launches, a customer survey, a manager's judgment, or a dataset containing only products that survived long enough to be measured. The target process is this launch with its own price, distribution, competitors, technology, and timing. The mismatch may exist before the first forecast is made. Earlier launches can still offer evidence, but they may not form a stable class that supports a calibrated 63%. Ask what counted as a case. Which launches were excluded? Was success defined the same way? Did failed ideas disappear before reaching the dataset? Were the products sold to the same customers under similar constraints? If those answers are weak, the number may still summarize informed judgment. But it should be labeled as judgment, not treated like a measured frequency. The immediate response is practical. Use a range or a small set of scenarios, run a limited release, identify the cheapest evidence that could change the decision. Keep resources for a second attempt. The goal is not to eliminate uncertainty, it is to avoid making the entire decision depend on a reference class that does not exist. Frank Knight gave this boundary its classic economic form in 1921. He used risk for uncertainty that could be measured across a group and uncertainty for situations where no reliable distribution could be established, often because the case was too unusual. Knight's argument is often simplified into a hard wall. Risk is measurable and uncertainty is not. His treatment was more careful. Perfectly uniform groups are rare in business, and almost no event is absolutely unique. The real question is degree. How closely does the available class resemble the decision now in front of you? That nuance prevents 2 errors. One is false precision, presenting a judgment about a unique future as if it came from thousands of repeated trials. The other is refusing to use evidence because the future is not perfectly repeatable. Historical cases can reveal base rates, constraints, and failure modes. Expert judgment can combine information that no dataset captures cleanly. But the weaker the reference match, the less authority the final percentage has earned. The decision must carry more of the uncertainty itself. Process mismatch can also emerge over time. The reference class may have been defensible when the model was built, while the target process later changed. In 2026, the Federal Reserve, the FDIC, and the Office of the Comptroller of the Currency issued revised supervisory banking guidance on model risk. The guidance describes models as simplified representations built from assumptions, methods, and data. It calls for validation and ongoing monitoring that can detect deterioration as products, exposures, clients, data relevance, or market conditions change. This is banking guidance, not a universal law for every forecast, but the mechanism travels well. A competently designed model can become less reliable when the environment no longer resembles the one where it earned its performance record. Imagine a lender builds a default model during years of low interest rates, steady employment, and conservative underwriting. The reference process contains borrowers selected under those conditions. The model may perform well on unseen records from the same period. Then financing costs rise, underwriting loosens, and the borrower mix changes. The target process now contains different incentives, different payment pressure, and a different population. The code still produces a loss estimate to 2 decimal places, but the reference process and target process have moved apart. The model has not necessarily become useless. Its old validation simply answers a narrower question than the current decision requires. Randomly holding back data may not reveal this problem. A test set can contain unseen rows while preserving the same economic regime, selection rules, and incentives. It shows that the model can handle new examples from a familiar process. It does not show that a new process remains familiar. The practical response begins before performance collapses. Name the conditions that must remain true for the estimate to travel forward. Monitor those conditions alongside prediction error. Use out-of-time tests when later data exists. Stress the assumptions that history contains only weekly. Decide in advance what change in borrower mix, financing cost, policy, or error rate would reduce confidence and trigger review. If a key condition moves outside the model's evidence, reduce the weight placed on the point estimate. Widen the range, stage the commitment, or redesign the decision so an early error is recoverable. The action should change when the evidence has changed, even if the software has not failed. The third route to process mismatch is feedback. Here, the model's output helps change the target process. Consider initial margin and derivatives markets. A participant may be required to post liquid collateral against possible future losses, and the amount can be informed by a risk model. A 2014 Bank of England staff paper describes how common risk-based margin models can increase liquidity pressure during stress. For the same portfolio, margin requirements may be lower in calm conditions and higher after volatility rises. Requiring more protection when measured risk increases is locally understandable. The difficulty is timing and coordination. When volatility rises, participants may need more collateral just as liquid assets become harder to obtain. Some may raise cash or reduce positions. If many participants respond under similar constraints, their combined actions can push prices, change volatility, and contribute to another increase in measured risk. Map the processes carefully. The reference process contains market movements and portfolio losses used to estimate future exposure. The target process also contains the behavior triggered when the estimate changes, collateral calls, cash demand, position reductions, and the reactions of other participants. If the model omits material responses that its own output can trigger, the target process is not the passive system described by the reference data. The estimate has become part of the conditions generating the next observation. Value at risk systems can contribute to a related pattern. Measured risk may fall during calm periods, allowing institutions to carry larger positions within their limits. When prices fall and volatility rises, measured risk can jump and limits can tighten. Synchronized reductions may then amplify market pressure. This does not mean margin models or risk limits cause every crisis. It means their reliability cannot be judged only by how well they fit past returns. The relevant target process includes how users respond to the output. The diagnostic question is direct. Does the model account for the material behavior its output may trigger? List who sees the number, what action it encourages or forces, what constraint those actors share, and whether many of them may act at the same time. Then test the joint response, not only the decision of one institution in isolation. The response is not to abandon risk controls. It is to include feedback in the analysis, preserve enough operational slack for stressed reactions, and avoid assuming that individually prudent actions remain harmless when synchronized. We can now turn the entire argument into one decision tool. Write down the reference process on one side and the target process on the other. Define the same outcome, population, and horizon for both. Then check 3 forms of match. First, cases. Are the observations behind the estimate meaningfully comparable to the case you face? Second, conditions. Do the assumptions and relationships that mattered in the reference period still hold in the target period? Third, feedback. Does the model represent the material behavior its output may trigger? All 3 questions point in the same direction. A stronger yes supports more weight within the model's stated limits. A weak answer identifies the exact kind of decision protection you need. Weak cases call for ranges, scenarios, expert judgment with explicit assumptions, and small experiments that create better evidence. Changed conditions call for assumption monitoring, out-of-time checks, stress tests, staged commitments, and update triggers chosen before the result is known. Omitted feedback calls for mapping reactions, testing simultaneous behavior, and preserving room to respond when many actors face the same signal. Notice what this framework does not promise. It does not reveal the one true probability. It tells you how much authority the available probability has earned and how to design a decision around what it has not earned. Return to the product team in its 63% forecast. The team can compare prior launches, but it should state which ones belong in the class and why. It can identify which market conditions must hold. It can ask how customers and competitors may react to the launch. Then it can change the decision rather than argue over a few decimal points. Release to a limited segment. Measure actual demand. Keep enough resources to revise the offer. Define the result that justifies expansion, revision, or exit. The forecast remains available as one input. The plan no longer requires it to describe the world perfectly. The same logic applies to the lender. A model trained in one credit regime can still supply a baseline, but a new borrower mix or financing environment should change how much weight that baseline receives and what evidence triggers a new validation cycle. It also applies to market risk controls. A measure can remain informative while its widespread use creates behavior that must be added to the target process. The question is not whether the model is good or bad. The question is whether it represents the system that now exists. There is one final objection. Are scenarios in judgment merely less disciplined guesses? They can be, if they are vague stories selected after the outcome. A useful scenario changes an explicit assumption and traces the operational consequence. A useful judgment names its reference cases, its uncertainty, and the evidence that would change it. Discipline does not require pretending that every future has stable odds. It requires matching the method to the evidence and the decision to the cost of error. Probability underpins much of modern insurance, engineering, medicine, and finance. Its value comes from the fit between the process measured and the process faced. Before trusting a risk estimate, ask, are the cases comparable? Do the key conditions still hold? Does the model represent material feedback from its own use? If the cases are comparable, the key conditions still hold, and material feedback is represented, the estimate may deserve weight within stated limits. If the match breaks, do not debate the decimal places. Change the decision, use scenarios, limit the cost of error, preserve reversibility, and define the evidence that will trigger an update. Do not confuse a precise number with a stable world. Which estimate in your work might be describing the wrong world?